Ethereum is much more important for the crypto market than most people realize. There are liquidity pools in decentralized finance where the altcoins are directly coupled with the Ethereum price. When Ethereum is going up 10, 20, 30%, most altcoins go up to the same degree. Now, because of that coupling, it's important to understand what's going on with Ethereum. Where is the demand? Where is the supply headed? Let's have a look at the data most people aren't considering. Let's try to figure out where Ethereum is standing relative to other cryptocurrencies. Ethereum is currently at $3,900. It seems like once we get closer to the $5,000 mark, there is this invisible ceiling many people seem to be selling. We have been there at the end of 2021 and we have just revisited very similar price levels again. In the last year, Ethereum made 47%, while Bitcoin made 53%. That's quite interesting given that there was so much hype around the Ethereum treasury companies, but more on that in a second. There have been two major rallies when we look at Ethereum's performance relative to the rest of the market. The first rally was driven by altcoin demand. So we're looking here at Ethereum dominance, how much of all of crypto is currently in ETH. And while there was quite a bit of volatility, there was also a central event everybody was looking forward to. That was the move from proof of work to proof of stake, or the merge. The day of the merge was a sell the news event. Unfortunately, afterwards, Ethereum tended to underperform up until we hit the historical bottom in Ethereum dominance again. That's when Tom Lee launched BitMine, so the leading Ethereum treasury company. Here's Ethereum that's held by various treasury companies. We can clearly see BitMine is dominating the space, so that's the area in blue. Once we remove BitMine from the picture, the acquisition of those treasury companies has halted, unfortunately. Since the beginning of September, there is very little purchases. And so that might partly explain Ethereum's recent weakness, why it can't outperform the rest of the market in the last weeks anymore. Now, I think there's actually a slightly better measure than looking at Ethereum's dominance, and that is the Ethereum market cap relative to the entire market cap, excluding the stable coins. So we're looking at ETH/total ES. ES meaning excluding stablecoins. And so here we can now see how the merge had been the exact top of that rally, which isn't that obvious on the dominance chart. The charts are not fundamentally different, but there is an interesting effect. What we see here at the bottom, that's the correlation coefficient of Bitcoin's market cap relative to total ES versus Ethereum's market cap relative to total ES. Now, this white line tends to be in the negative. So that means Bitcoin's dominance and Ethereum's dominance tend to move in opposite directions at the same time. There's a lot of capital rotation happening from Bitcoin to Ethereum and from Ethereum to Bitcoin. And so really, it's not surprising when we look at all of those kinds of charts that when we see the Ethereum market cap relative to the Bitcoin market cap, we see pretty much again the same chart. Ethereum dominance, or Ethereum relative to the altcoin market except stablecoins, or Ethereum relative to Bitcoin. All of those charts show a historical trading range. Now, the dotted line that we have here, that's the average ratio of Ethereum's market cap to Bitcoin's market cap. So just based on that, Ethereum might still be slightly undervalued. Ethereum could rally versus Bitcoin another 38% until we hit equilibrium. The question, of course, is what could cause another rally, right? It's not going to be BitMine. BitMine is acquiring at a pretty predictable rate. There has to be some positive catalyst that leads Ethereum to outperform specifically Bitcoin. So really what seems to matter most for Ethereum is how is Bitcoin doing? Are people willing to sell their safe Bitcoin to get more risk on and buy Ethereum? Once Ethereum's price is going up, then as per extension, the altcoins go up as well through the liquidity pool coupling. Now what we're seeing here, that's the Ethereum supply growth relative to the Bitcoin supply growth. So Ethereum is the line in blue, Bitcoin is the line in orange, and both assets have pretty much the same expansion in terms of how much constant selling pressure there is. Now there is a fine difference here. And I'm not talking about the 0.03, 0.04 percentage points, but rather the future development. By the way, if you're enjoying this video so far, then feel free to give it a like. It will help to spread the word. It will tell the algorithm to show the video to more people. Thank you very much. Because Bitcoin will go through a halving event at the beginning of 2028. So the newly issued supply will fall from 0.8 to 0.4%. And so that's something we will not see for Ethereum. For Ethereum, the only way to reduce the additional supply is to incentivize more usage of the blockchain. So directly of the layer 1, not of the layer 2s, not of Arbitrum or Optimism or any of those layer 2 scaling solutions. Those take away a lot of the gas usage from Ethereum. Because once we don't just look at the last 7 days, but we zoom out a little bit, we look at the development of the circulating supply since the merge, which is now more than 3 years ago, we have an interesting development for Ethereum. Ethereum used to be ultra sound, as in the circulating supply went down. That's because of the burning mechanism. So the more Ethereum is used on chain, the more ETH is getting burnt. Thus, the circulating supply has the potential to decline. Currently, Ethereum isn't used enough though, and so both Bitcoin and Ethereum expand at a similar rate. So for Bitcoin, we know for sure that tokenomics will improve. For Ethereum, we have to hope that they will improve. Right now, the trend is moving in the opposite direction, as in the amount of Ethereum that's used for smart contracts is declining. This here is the Ethereum supply. And have a look at where the supply is headed. The purple area, that's the supply that's in smart contracts. That tends to decline since 2022. The red area, that's the supply that's in individual accounts. And the area in turquoise, that's what we have staked in Ethereum validators. So really, when the Ethereum and smart contracts tends to decline, that's rather a sign of less usage of the Ethereum chain, which then of course leads to less burning of ETH tokens, which then of course leads to not much better tokenomics compared to just buying Bitcoin. And so Ethereum is going through a transition period. It used to be used mainly for decentralized finance, but then after DeFi winter, we have seen a bit of a recovery, but we don't see new all-time highs. And now Ethereum is mainly used to simply house stablecoins. But let me first show you what I mean. This is the total value locked of the Ethereum chain measured in ETH. So how many Ethereum are used across different DeFi platforms? And this did not grow beyond prior heights 5 years ago. This was the DeFi winter, the subsequent recovery, but we aren't growing any further. What is growing though is the stable coins that's on the blockchain. Ethereum is dominating the space. It's got 53.5% of all stablecoins across all chains. And it's a very quickly growing market. This is all stablecoins across all blockchains over time. And this did hit a new all-time high. Very different to the decentralized finance usage. So there is a real growth catalyst for the Ethereum ecosystem. How quickly is this recently going up? When we measure this from the last 12 months, we are looking at a growth rate of 65% per annum. And that growth, of course, will benefit the Ethereum price as well, right? Some people that swap into those stablecoins might end up buying ETH directly as well. Have a look at a few on-chain metrics. Here's the number of transactions over time. While the growth isn't as parabolic as it used to be, the ecosystem is definitely not shrinking. It continues to grow. The price has a hard time going above $5,000, but the number of transactions is growing higher and higher. Here's the number of active addresses. This also tends to slowly go up. Here are the chain fees, which crash down. This is due to the move from proof of work to proof of stake. It's also due to the adoption of layer 2 solutions on top of Ethereum. So that's Arbitrum, Optimism, the base chain. Those are all Ethereum virtual machine blockchains. So any contract that can be executed on the Ethereum chain can also be executed on those layer 2s. And those layer 2s are much cheaper in terms of gas fees. So activity moved towards the layer 2s, which helped free up space for the Ethereum main chain. That's why the chain fees are now so low. Ethereum itself is getting usable again. The app fees stay elevated though, and money continues to get bridged towards Ethereum. This is the bridge aggregator volume over time. And here are the net inflows. So the data does look quite healthy. This is the decentralized exchange trading volume on the Ethereum chain over time. Here's the DEX aggregator volume, so that's 1 inch for example. And here's the one trend that Ethereum is missing unfortunately, and that is perpetual futures trading. So there used to be a lot of activity at DYDX and at GMX, But now that's all moving to hyper liquid. And so decentralized exchanges that enable betting with leverage on crypto prices, that's moving away. But that's really not the major source of growth for ETH. The major source of growth for ETH is inflows from traditional finance. It's the expansion of the stablecoin market cap, which still grows very consistently and very quickly, 65% per annum. It's, by the way, expanding since October of 2023. This turnaround over here, that was when Terra Luna imploded. And during that contraction, FTX went belly up as well. And so while perpetual futures trading went away from the Ethereum chain, bets on the Ethereum price outside of ETH are still going up. So on Binance and on Hyperliquid, etc., we see more and more perpetual futures trading volume on the Ethereum price. It's now much higher today compared to 4 years ago. The price is at similar levels. The perpetual futures trading volume is not. That has grown much more. So has the open interest, by the way. So the amounts of bets on the Ethereum price. The asset has a similar size, but the amounts of bets went from 10 billion all the way to 50 billion. Now there's a very interesting misconception with altcoins. Have a look at this chart here. This shows total 3 ES divided by Bitcoin. Now what does this mean? Total 3 is the market cap of all cryptocurrencies that are not Bitcoin and Ethereum. ES means that we also exclude stablecoins. So this is all of the volatile altcoins that are not Bitcoin and Ethereum. And we look at that market cap relative to Bitcoin's market cap. So how are the volatile altcoins doing relative to Bitcoin? And it seems like this is trading in a range in the last 8 years. If we just look at the prior year, we also seem to just performed in the same way as Bitcoin. But clearly that is not true. Have a look at the performance of these smaller altcoins in the last year. Pretty much everything is red while Bitcoin went up. The key to the puzzle is to understand the difference between market cap and price. This here is an example of WorldCoin. WorldCoin over the years saw an increasing market cap. It went from a peak of 1.5 billion to 2.5 to more than 3 billion. So WorldCoin tended to grow in market cap. But have a look at the long-term price chart. It looks very different. WorldCoin's price peaked at close to $10 and is now below $1. There can be a massive disconnect. In this chart here, it just looks at the altcoin market cap relative to the Bitcoin market cap. And this is true for many altcoin related metrics. It's true for the others market cap. It's true for the others dominance. It's true for dominance charts in general. When we look at the Bitcoin dominance or the Ethereum dominance, we are just comparing market caps. We are not comparing prices. Even when the Bitcoin dominance stays stable, Bitcoin very likely has outperformed most altcoins because altcoins might have been stable in market cap, but they might have gone down in price. This effect that we see for WorldCoin is very typical for altcoins. Now here's the circulating supply of WorldCoin. Again, just an example of what's going on with the market. We had 500 million WorldCoin at launch, and that more than 8x'd over the span of 2 years. When we look at the entire altcoin market, at least the tokens that are tracked by Tokenomics.ai, we've got weekly unlocks of roughly $1 billion. So if the demand for the altcoin market is below $1 billion, if the altcoin market doesn't grow that much every single week, then the price goes down. Because all of those unlocks, they are tokens that get allocated to the early investors of the altcoin projects. They get allocated towards the founders. They get allocated towards the insiders. So they are cashing out at a rate of 1 billion per week. And if the retail investor doesn't buy at the same rate, then price goes down. So here is an example. This is WorldCoin in US dollars. Here is WorldCoin relative to Bitcoin. So much more consistent underperformance. Now there are two potential takeaways from this. The first one would be to just completely stay away from altcoins altogether. Altcoins are rigged, altcoins are through dump on retail investors. But the second potential takeaway is to maybe flip this thing around. So we are betting on falling prices of WorldCoin, while at the same time betting on rising prices of Bitcoin. So when we flip this chart, we get this here. This looks quite interesting, doesn't it? Since launch, Bitcoin outperformed WorldCoin by 836%. So that's the kind of performance we are looking for. The problem, of course, is volatility, especially here at the end. So WorldCoin occasionally does have positive news. It still has development. It's still an active project. And so a strategy like this can still lead to temporary drops of 55%. Despite the long-term outperformance. So the idea to bet on token inflation structurally is a good one. The idea to bet on falling prices when things look like this is a good idea. But risk management is crucial, and we have to look at assets that don't have that much more active development, where we don't see any positive news around the project anymore. Here's an example I like to give regularly on this channel. This is Bitcoin relative to Balancer. Balancer also has a high token inflation. And yes, there can be some drawdowns along the way as well, but they're not 50%, they're only 30%. And on a logarithmic chart, this looks much more manageable. And so this strategy doesn't just work in theory, it actually does work in practice. Let me show you how. When we look at this relative valuation chart of Bitcoin to Balancer, and we compare this to just buying and holding Bitcoin, so that's now the line in orange, we can clearly see how betting on the differential, so betting on falling Balancer prices by betting on rising Bitcoin prices, has a way better long-term risk-adjusted return. And so I followed this strategy for the last 4 years. This is a monthly chart. Had I just dollar cost averaged into Bitcoin, I would have gotten the performance here in light gray. But because I also bet on falling altcoin prices at the same time, I got the performance here in black. Now the problem is, just because I make profit with that strategy doesn't necessarily mean that you have to make profit with that strategy. But I do believe in the strategy that anybody can mirror similar performance. What we've got over here is a copy trading vault. So the premium members of this channel had the possibility to invest in a capital pool. That capital pool is closed until the end of the year. But anybody that deposited in July of this year is now up roughly 20%, while Bitcoin since then went down in price. Of course, the massive market disruption that we saw recently helped us as well. It was actually the best weekly return ever. It brought us more than 9%. Most others got wrecked, but we made money. And so I made several videos on the topic. There's one video explaining the copy trading vault, but again, that vault is closed until the beginning of the year. But here are the two more important videos: using perpetual futures to bet on relative valuations, and risk management with relative valuation bets. Risk management is extremely important, because if you don't know how to do that, you get wrecked during volatile times. You don't make money. So here are the two videos. This is 34 minutes in length. Here's the other video, 28 minutes in length. And once you've watched those two videos and you've joined the premium groups, I will share my favorite trade with you. So the favorite trade will look very similar to the Balancer trade that we looked at. If you are not making money with that favorite trade after holding it for 1 month, I will refund the premium membership fee to you. So really, you are not risking those 125 US dollars. If you're not making money with the trade, you just get this refunded. I will not ask any questions. If you want to be part of the next copy trading vault and you don't want to make the trades yourselves, you simply just want to deploy capital, then feel free to check out this video over here. This was the introduction to the vault from July. And feel free to consider to sign up for the annual membership, because the yearly subscribers, they get access to that copy trading vault that currently is closed. Of course, you can simply start out with monthly, start the trading yourself, and then swap to the annual membership later on. A link to premium pops up directly here on the screen. Just click on that. It will lead you to the website. If it's the very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. So next time on YouTube, or see you in premium. Cheers.